global markets are in turmoil. The catalyst is President Trump's aggressive new round of tariffs. Investors worldwide are reacting with panic. The fear of a global recession is rising. Share prices have plummeted for the third consecutive day. This decline follows Trump's announcement of new tariffs on trading partners last Wednesday. The situation escalated dramatically on April 6th. Trump doubled down on his tariff policy. He even threatened to impose an additional 50% tariff on Chinese imports. Asian markets were hit particularly hard. Major indices in Japan, Hong Kong, and China all experienced significant drops. European markets followed suit. The FTSE 100 in London, for example, closed down 4.4%. This represents its lowest point in over a year. Paris and Berlin also saw their stock markets close significantly lower. The uncertainty surrounding the trade war is palpable. Businesses are delaying investment decisions. Consumers are worried about rising prices. This anxiety is reflected in the falling price of oil. Oil is often seen as a barometer of the global economy. Its decline suggests that traders anticipate lower demand in the near future. The situation remains fluid and volatile. The International Monetary Fund has issued a stark warning. They predict that a full-blown trade war could shave 0.5% off global growth by 2025. This would represent a significant blow to the world economy. The impact of the escalating trade war is most evident in the United States and Europe. The Dow Jones Industrial Average, a key indicator of U.S. market health, has plummeted by 500 points. This drop reflects the deep uncertainty gripping American businesses and investors. The S&P 500, a broader measure of the U.S. stock market, has also experienced substantial losses. It has shed trillions of dollars in value since Trump's initial tariff announcement. This market volatility underscores the fragility of the current economic climate. The FTSE 100 in London, a bellwether for European markets, has also been battered. Its decline of 4.4% reflects the interconnectedness of global trade. European businesses, many of which rely on exports to China and the US, are now facing a significant threat to their bottom lines. The situation is further complicated by Britain's impending exit from the European Union. The uncertainty surrounding Brexit was already weighing on the UK economy. The added pressure of a global trade war only exacerbates these concerns. The economic damage is not limited to stock markets. The fear is that these market declines are a harbinger of a broader economic slowdown. If businesses lose confidence and consumers tighten their belts, it could trigger a recession. Despite the global market turmoil, President Trump remains defiant on his tariff policy. He argues that tariffs are necessary to protect American jobs and reduce the trade deficit with China. In a series of tweets and public statements, Trump has doubled down on his protectionist stance. He has dismissed concerns about a trade war, claiming that the US is winning and that China will ultimately back down. Trump's rhetoric has done little to calm the markets. In fact, his aggressive stance seems to be fueling the uncertainty and volatility. Many economists argue that tariffs are ultimately harmful to the U.S. economy. They point out that tariffs raise prices for consumers and businesses, reduce economic efficiency, and invite retaliation from trading partners. The Trump administration, however, remains committed to its course of action. They argue that the tariffs are a necessary tool to force China to make concessions on trade practices that the U.S. considers unfair. They also point to the fact that the U.S. economy remains strong, with low unemployment and steady growth. China has responded to Trump's tariffs with retaliatory measures of its own. They have imposed tariffs on a range of U.S. goods targeting key exports like soybeans and automobiles. China's response was swift and calculated, indicating that they are prepared for a protracted trade war. This tit-for-tat escalation has heightened fears of a global recession. Economists warned that a full-blown trade war between the world's two largest economies would have devastating consequences. It would disrupt global supply chains, increase costs for businesses and consumers, and dampen economic growth worldwide. The International Monetary Fund has already downgraded its global growth forecast for 2025, citing trade tensions as a primary concern. The escalating trade war has also contributed to a decline in oil prices. Oil prices have fallen by more than 10% in recent weeks, as investors worry that a global economic slowdown will reduce demand for energy. This decline in oil prices, while potentially beneficial for consumers in the short term, could have negative consequences for oil-producing countries and energy companies.